In this lecture, we explore the U.S. taxation of the U.S. source non-business income of non-resident aliens and foreign corporations. In a separate lecture, we will cover the income tax withholding rules that apply to this income. The objectives of this lecture are to understand the following: the types of income that are characterized as non-business income, the manner in which non-business income is taxed, the exclusions or exceptions from U.S. taxation of this income, and the effect of U.S. tax treaties on non-business income. This lecture includes a PowerPoint audio-video portion and a written portion. The written portion has two parts: the script for this lecture and the authoritative reading assignments. The citations for the authoritative reading assignments are noted in the left column of the written lecture. You can click on each citation to go directly to the assigned reading. The reading assignments themselves are located after the written lecture. An index of all of these reading materials is at the top of the written lecture. One way to interact with this lecture is to listen to the recorded lecture first while following along in the written lecture or the written script. This provides an overview of the material. Then go back to the written lecture and read the cited material in the order presented in the lecture. You can also use the text Fundamentals of International Taxation to read more on a particular topic. The discussion of the material in this lecture is primarily at pages 67-3 to 67-56. Let's first look at the basic scheme for the taxation of non-business income under U.S. domestic tax law. As explained at Section 871A for non-resident aliens and Section 881 for foreign corporations, non-business income that is subject to tax and withholding at 30% is the amount received as gross income from sources within the United States, no deductions allowed, that is not effectively connected with a U.S. trade or business. The amount for this purpose is income received and recognized on a cash basis. Income included in gross income is determined under all U.S. statutes. For example, municipal bond income is not included in taxable gross income for regular tax purposes, so is not included in non-business income. The amount of income that is U.S. source is determined by statute, primarily sections 861 to 865. U.S. tax treaties ordinarily have the effect of reducing or eliminating the tax on non-business income. Most commonly, such treaties reduce or eliminate the tax on U.S. source dividends, royalties, and interest. Before going further, I want to clarify my use of the terms non-business and business income. These are terms of convenience used in this course. Non-business income generally refers to all income defined in sections 871A and 881. This is income that is not connected to a U.S. trade or business, or USTB. Business income is income referenced in either section 871B or 882, which is income effectively connected with a U.S. business. The terms non-business and business income are not used in the code in the manner that I use them. However, using the terms in this course makes it easier to explain things. Here are the types of non-business income identified by sections 871A and 881. Non-business income mostly includes interest, dividends, rents, royalties, and annuities. Non-business income also includes other fixed or determinable annual or periodic gains, profits, and income. This is known as FEDAP income. Other FEDAP income can include U.S. source salaries, wages, premiums, and other compensation. We will go into the exact types of income that meet this definition later. U.S. source capital gains of non-resident aliens are taxable as non-business income in the United States only with respect to aliens present in the United States for 183 days or more. Also included are gains from natural resources sales, original issue discount, and gains from sales of intangibles. Before we go further, it is important to understand that income that is normally non-business income can be effectively connected income taxed at regular tax rates. This lecture focuses on non-business income taxed at 30%, identified in sections 871A and 881. Feed-up income, original issue discount, natural resources gains, intangibles gains, capital gains. Such income is taxed as non-business income only if it is not connected with a U.S. trade or business. All of the various types of income in sections 871A and section 881A can be connected with a U.S. trade or business, in which case the income is taxed as ECI at regular tax rates. As we will discuss in a later lecture, income can be connected with a U.S. trade or business under the asset use test and the business activity test. Here's an example of the asset use test. Foreign Corp operates a business through a branch office in the United States. Among the assets of that business are an interest-bearing bank checking account in a U.S. bank used exclusively in business operations. The cash balance in the account is sufficient only to meet the operating needs of the company, payroll, purchasing, rent, etc. Foreign Co. also owns certificates of deposit issued by the same bank, which are used to maintain reserves for future needs. The bank account is used in day-to-day business activities, and the CDs are not. Under the asset use test, interest income earned in the checking account is effectively connected income, and interest on the CD interest is feed-up income. Here are other basic rules for the taxation of non-business income. Gross non-business income is taxed in the United States at a rate of 30%, and no deductions are allowed against this income. In general, non-resident aliens and foreign corporations are taxable in the United States on non-business income that is sourced in the United States, regardless of whether they are otherwise engaged in the conduct of a business in the United States. Non-business income, other than capital gain, is subject to withholding at source by the payer at a flat rate of 30%. Capital gains, other than gains on dispositions of U.S. real property interests, are not subject to withholding. In theory, the amount withheld is supposed to equal the amount of tax, so foreign persons with non-business income may not be required to file U.S. tax returns. The rules for determining the taxability of non-business income are substantially the same for non-resident alien individuals and foreign corporations. So in this lecture, we will not differentiate between the two unless necessary. Here's an example of taxation of a non-resident alien individual. Chen is a country ex-citizen and resident who spends a few weeks each year visiting relatives in New York and spends no other time in the United States. She has various investments in the U.S. that earn U.S. source non-business income in the form of dividends and capital gains, and she has U.S. source income that is effectively connected with a U.S. trade or business. If no U.S. tax treaties apply, 30% withholding is required on all of her U.S. source dividends, and no withholding is required on her capital gains or her effectively connected income. If the dividends are earned from stocks held in a U.S. brokerage account, then the brokerage account would be required to withhold on the dividends. Note that the brokerage house would normally ask Chen for a Form W-8-BEN to confirm her non-resident status. The result would be the same if Chen was a foreign corporation instead of a non-resident individual. Let us turn to the non-business income that will be covered in this lecture. Non-business income that is taxable in the United States and which we will cover in this lecture includes the following: dividends from U.S. companies, interest from borrowers in the United States, rents on property located in the United States, royalties on property used in the United States, U.S. source capital gains. We also cover compensation for personal services performed in the United States, which is included in the types of income described as FEDAP income, but is ordinarily taxed as effectively connected income. It is important to note at this time that when paid to non-resident aliens, personal services income can be subject to withholding, even when classified as effectively connected income. More on this later. We're going to start the discussion with dividend income. Under domestic tax rules, U.S. source dividends are taxed as FEDAP income in the United States and are subject to 30% withholding. Such dividends include the following. Such dividends primarily include any distributions from current or accumulated earnings and profits of U.S. domestic corporations. There are provisions that can make dividends from foreign corporations taxable as well, notably the 25% rule. And there are provisions that exempt dividends from tax, including dividends from existing 80/20 companies and dividends from regulated investment companies. As one of the few exceptions to the general rule, dividends from foreign corporations can be considered U.S. source income subject to tax and withholding if at least 25% of a foreign corporation's gross income is effectively connected for the 3-year period ending prior to the current taxable year. Then dividends paid in the current year are partly U.S. source income subject to 30% tax and withholding. When this inclusion rule applies, the taxable dividends are determined by multiplying the total dividends by a fraction, the numerator of which is the corporation's effectively connected gross receipts, and the denominator is all gross receipts. While dividends are treated as U.S. source income under this rule, they are not treated as FEDAP income. Here's an example of the 25% test. In 2021, Foreign Corp, a Country X corporation, pays a cash dividend of $10,000. For the 3-year period ending with 2020, Foreign Corp has been engaged in a U.S. trade or business and has received gross income effectively connected with the conduct of that trade or business, amounting to 80% of its gross income from all sources for such period. Of the total dividend, $8,000, $10,000 times 80%, is treated as income from sources within the United States, but is not taxed as FEDAP income. Dividends received from an existing 80/20 company are generally exempt from tax. See the material referenced in this lecture for a brief discussion. Dividends from regulated investment companies can be wholly or partially exempt from tax. See the material referenced in this lecture for a brief discussion. U.S. tax treaties have a substantial impact on the taxability of dividends. Under U.S. tax treaties, the tax and withholding rates on otherwise taxable dividends can be reduced from the statutory 30%. Dividends can also be exempt. The U.S. model tax treaty reduces the rate to 15%. However, rates are set in each country's treaty with the United States and can vary with each country. If the beneficial owner of the dividend is a foreign corporation that owns at least 10% of the paying corporation, then the rate is lower than the above 15%. The U.S. model treaty sets this rate at 5%. However, once again, rates are set in each country's treaty with the United States and can vary with each country. If the dividends are attributable to a permanent establishment of the recipient in the United States, then the dividends are taxed in the United States as business profits. We will consider permanent establishments in a later lecture. Here's an example of reduced withholding under a U.S. tax treaty. Domestic Co. is a U.S. corporation that pays dividends to Foreign Corp., a U.K. corporation. Foreign Corp. Owns less than 10% of Domestic Co.'s stock. Under the U.S.-UK tax treaty, U.S. source dividends are subject to income tax and withholding in the United States at a rate of 15%. If Foreign Corp. Owned 10% of the stock of Domestic Co., then under the treaty, income tax and withholding would be imposed at only 5%. We're now going to consider interest income, that is non-business income, and which is taxed at 30% rate. Interest income that is considered U.S. source FEDAP income is generally subject to 30% tax and withholding. This taxable interest is generally interest paid on the debts of a U.S. person, including obligations of U.S. obligors, including the U.S. government and its agencies, debts of U.S. citizens and residents, loans to U.S. corporations and U.S. partnerships, and the obligations of a foreign taxpayer if that interest is effectively connected with a U.S. trade or business of the foreign taxpayer. However, U.S. source interest income is exempt from tax if it is deposit interest, portfolio interest, or interest from an existing 80/20 company. See the material referenced in the lecture for a brief summary of existing 80/20 companies. A major exclusion from tax on interest income is the exclusion for interest on deposits. Under this exclusion, interest paid to foreign persons in connection with the following is not subject to the 30% tax and withholding: bank deposits, deposits with savings and loans, interest paid by an insurance company on amounts paid on accounts held by the company. Note that this exclusion is not affected by a depositor's ownership of the payer. This exclusion does not apply to bank deposits that are connected to a U.S. trade or business, making the interest income effectively connected income. This effectively connected rule is discussed later in this lecture. Here's an example of bank deposit interest. Sinclair is a Country X citizen and resident with $1 million deposited in Domestic Co., a U.S. bank. He owns 25% of the common stock of Domestic Co. Despite the fact that he owns stock in Domestic Co., he can exclude from U.S. taxable income the interest he earns on these deposits. Portfolio interest income is excluded from the 30% tax and withholding on non-business income. Portfolio interest, which is excluded from the 30% tax and withholding, includes stated and understated interest and OAD related to the following when received by a foreign person: debt obligations issued in registered form, and unregistered debt instruments that are designed to pay interest only outside the United States and only to foreign persons. These are known as bearer obligations, and this provision applies only to debts issued before March 19, 2012. To qualify for the exemption from tax, the holder must provide the borrower with a certification of foreign status, such as a Form W-8BEN. Form W-8BEN is discussed in Lecture 2-2. Interest received by a 10% shareholder or partner does not qualify for the portfolio deduction. This interest includes OID and unstated interest. For this purpose, the ownership attribution rules at Section 318 are applied but are modified by Sections 871 and 881. Contingent interest does not qualify for the portfolio deduction. Contingent interest includes interest determined with reference to receipts, sales or other cash flow, profits, changes in the value of property, dividends, partnership distributions, or similar payments made by the debtor, and other types of contingent interest identified in the regulations. Here's an example of interest on a registered obligation that qualifies for the exemption. In 2021, Domestico issues $50 million in 10-year registered bonds, paying interest at a rate of 4%. Alan, a country ex-citizen and resident, purchases bonds with a face amount of $1 million and receives interest of $40,000 per year. He provides a Form W-8-BEN indicating that he is a non-resident alien individual. Under the portfolio interest exception, the interest income will not be taxable in the United States and not subject to withholding. Here's an example of interest earned by a 10% owner of a U.S. corporation. Smith, a non-resident alien, owns 20% of Foreign Corp, a country X corporation. Foreign Corp owns 50% of the common stock of Domestico. Smith buys $1 million of the registered bonds issued by Domestico. Assume that without considering Smith's indirect ownership of Domestico, the interest would qualify as portfolio interest that is exempt from U.S. tax. However, Smith owns, by attribution, 10% of Domestico, and the interest received from the bond is taxable in the United States. Here's an example of contingent interest. Flores loans $5 million to Domestico, a U.S. corporation, for a term of 5 years at an annual rate of 1%, with additional interest payable of 9% per year if Domestico's net profits for the period of the loan increase by 20% per year. The non-contingent interest of 1% per year is subject to the portfolio interest exception. However, the 9% interest is contingent and is taxable in the United States. The taxability of foreign persons on interest received from U.S. borrowers is affected by U.S. tax treaties. If interest received from U.S. borrowers is exempt from tax under rules discussed in the previous slides, then it is ordinarily exempt from U.S. tax under U.S. tax treaties. As an exception to this rule, interest income attributable to a business carried on through a permanent establishment in the United States is considered business income that is taxed as part of the business income of the permanent establishment. Original issue discount, or OID, is taxed in a manner similar to interest income, but is subject to special rules. OID income is recognized in a period when there is a payment on the related debt or a transfer of the obligation. The amount recognized is based on the OID accrued while the instrument is held by the taxpayer. The income recognized is taxed as non-business income, but is not included within FDAP income. If an original issue discount obligation has a term of 183 days or less, then the obligation does not meet the definition of an OID obligation under the rules for non-business income, and the amount of accrued OID is not taxable as OID. A next major category of business income is royalties. Royalties on copyrights, patents, secret processes, trademarks, know-how, and similar intellectual property are subject to 30% tax and withholding as FDAP income. Such payments when classified as royalties, are subject to the tax regardless of whether they are received in periodic payments or are received as a lump sum. An example of the latter is, for example, prepaid royalties. Payments with respect to transfers of intangibles are generally not considered royalties. However, if such payments are contingent upon the use or productivity of the property that is purportedly sold, then the payments are recharacterized for this purpose and for treaty purposes as royalties subject to withholding. Most U.S. tax treaties exempt or reduce the tax rates on royalties when they are earned by foreign persons. U.S. tax treaties generally exempt a foreign person from U.S. tax on U.S. source royalty payments or reduce significantly the tax on such payments. The exemption applies to royalties for the use of any copyright of literary, artistic, scientific, or other work, including films, any patent, trademark, design or model, plan, secret formula, or process, or for information concerning industrial, commercial, or scientific experience, and gain derived from the sale of any of this property to the extent that such gain is contingent upon the productivity, use, or disposition of the property is considered a royalty. Note that the treaty exemption is not available to the extent that the royalties are attributable to a permanent establishment in the United States. Such attribution recharacterizes this income as business income for tax treaty purposes. Here's an example of a transaction involving intangible assets that create royalties subject to withholding. Foreign Corp is a country X corporation that sells a patent to Domestico, a U.S. corporation. The transaction involves the complete transfer of all of Foreign Corp's rights in the patent. Domestico will use a patent in product X, which it will sell in stores in the United States. The sales price of the patent is based on product X sales over a period of 10 years. No tax treaty applies to this transaction. Because the sales price is based on the use or productivity of the patent, all payments to Foreign Corp are royalties that are subject to 30% tax and withholding. The next category of non-business income is rents. Rents received for the rental of property located in the United States are U.S. source non-business income that is subject to 30% in tax and withholding so long as the rental activity is not a trade or business. If the rental activity is a trade or business, then the rents are effectively connected income and the gross receipts are not subject to 30% tax or withholding. We will discuss effectively connected income in a later lecture. If a real property rental activity is not a trade or business, the taxpayer can make an election to treat the income from the real property rental as effectively connected income, even though the activity is not a U.S. trade or business. Note that the election also applies to rents and royalties from mines, wells, or other natural resources, and it applies to gains from the disposal of certain timber, coal, or domestic iron ore. The advantage of having income from a rental activity treated as ECI, whether because the activity is a U.S. trade or business or the election is made, is the taxpayer is allowed to take deductions against the gross rents, and U.S. tax is imposed at regular marginal tax rates, not the 30% flat rate, and there's no withholding. U.S. tax treaties ordinarily characterize real property rents as business income, taxable only to the extent attributable to a permanent establishment in the United States. This result should be the same as taxing property as a U.S. trade or business under the U.S. domestic tax rules. Here's an example of the rental of real property in the United States. Yoshino is a country ex-citizen and resident who owns real property located in Chicago that she rents to an unrelated person. Her rental income is $250,000 and her expenses are $175,000. If the activity is not treated as a trade or business, and if no tax treaty applies, then the tenant must withhold tax on the gross rents of $250,000 at a rate of 30% without reduction for expenses. If, on the other hand, the rental activity is a trade or business, then no withholding is required, and Yoshino pays U.S. tax at regular rates on her net income of $75,000. In addition, if the activity is not a trade or business, then she can make an election to treat the income as ECI, in which case there is no withholding and her taxable income is $75,000. Non-business income theoretically includes compensation for personal services. However, such income will ordinarily be treated as trade or business income. FEDAP income, subject to 30% tax on gross income, includes compensation. So, theoretically, compensation for personal services of an NRA or foreign corporation could be FEDAP income. However, compensation for the labor or personal services is ordinarily considered income from U.S. sources when the services are performed in the United States, and personal services performed in the United States ordinarily constitutes a U.S. trade or business, so such income is usually effectively connected income, which is subject to tax at graduated rates and can be reduced by deductions. However, non-employee compensation paid to non-resident aliens, while not subject to the flat 30% tax, is ordinarily still subject to 30% withholding, as discussed in Lecture 2-2. Tax treaties provide exemptions for services performed in the United States. However, these are exemptions related to compensation that is otherwise taxed as effectively connected income and will be discussed in a later lecture. Here is an example of compensation for personal services. Smith is a Country X citizen and resident who provides on-site consulting services. He travels to the United States and spends 6 weeks with the client providing services. The services performed are personal services. Such services are deemed to be a U.S. trade or business. And the source of the income is the U.S. because that is where the services are performed. As such, as we will learn in the lecture on business income, the compensation for services is effectively connected income, not non-business income, and is therefore subject to tax at graduated rates. However, the income may still be subject to withholding at 30%. With exceptions, capital gains are taxed as non-business income, subject to 30%, but are not subject to withholding. Non-resident aliens and foreign corporations are both taxed on U.S. source capital gains. When taxable, the rate is 30% on net capital gains. Special rules apply to determine if non-resident aliens are subject to tax on capital gains. Capital gains, when taxable under this provision, are not subject to withholding. The rules for capital gains in sections 871 and 881 do not apply to gains from dispositions of U.S. real property interests. These gains are the subject of a later lecture. Non-resident aliens are subject to a special rule to determine if they are subject to tax on U.S. capital gains other than gains on the sale of real property. For non-resident aliens only, U.S. source net capital gains are ordinarily taxable in the United States only if the non-resident alien is physically present in the United States for at least 183 days during the taxable year. For purposes of the 183-day capital gain test, the various exclusions of days applicable to the substantial presence test for non-resident alien status do not apply. For example, the rule excluding days present as a student does not apply. It is therefore possible for a non-resident alien to not meet the regular substantial presence test for resident alien status, but to meet the 183-day test under this special rule. Even if a non-resident alien meets the 183-day test, gains recognized under this rule include only U.S. source gains. For this purpose, under Section 365A, U.S. source gains include only gains from sales by a U.S. resident. For this purpose only, a non-resident alien is a U.S. resident only if the non-resident alien has a tax home in the United States. Caution, this definition of U.S. resident is only for the purpose of sourcing gains from sales of personal property. Do not confuse it with the substantial presence test for resident alien status, which we studied in week 1. Here's an example of the taxation of capital gains. Spicoli, an NRA, is a country ex-citizen and resident who is physically present in the United States for 175 days in 2021. During 2021, he has capital gains from the sale of stock in U.S. domestic corporations. Because he was not present for at least 183 days, his gains are not taxed in the United States. Assume that instead of 175 days, he is present for 183 days and is treated as a resident alien for 2021. The special rule for capital gains applies only to non-resident aliens, so does not apply to him. Now assume that he is present for 183 days with a tax home in the United States, but is not a resident alien because he was a student in 2021. He meets the 183-day test for capital gains, and the gains are U.S. source because he is a U.S. resident under Section 865G. He is taxed on the net gains at 30%. U.S. source non-business capital gains of foreign corporations are feed-up income, but these gains ordinarily do not occur. Foreign corporations are generally not U.S. residents under the definition at Section 865G. Foreign corporations are taxed in the United States on U.S. source non-business capital gains as feed-up income. However, because they are not U.S. residents, under the sourcing rules at Section 865A, their non-business capital gains are not U.S. source. Business gains of foreign corporations can be U.S. source under special rules in Section 865. We will discuss these in a later lecture. There are several other types of non-business income which we will not discuss here. See the brief discussions of these income types in the written lecture file. Social Security income, pension and annuity income, alimony income, scholarships and fellowships, grants, prizes, and awards, wages, and similar compensation. See IRS Publication 515 and the Catalyst publication referenced in the written lecture for guidance on taxation and withholding related to these topics. Also see the links in the lecture for summaries of these topics.